Carolina, and thank you for joining us. And to everyone watching the stream live, a big welcome. It is Friday, the 18th of March, and it's been a pretty busy end to the week as well. We do have a little bit to go over with Kim Hong here with the Bank of England monetary policy summary. And we also have the rate decision as well out from the Bank of England, and it did go up, and there was quite a lot of downside volatility as well. So that was hopefully didn't catch anyone by surprise, but strange markets, to be honest. And we also have Jin going through the CAD, and we'll also be touching upon a little bit on how oil has been moving, as well as it is continuing to, throw in some surprises. It did rally a little bit, Brent crude last night. I'll be going through the DXY, some equity market movements as well out of Australia, and I'll also be touching upon crypto at the end of the episode as well. So thanks to everyone joining us live as well. But before we do get into the trade ideas and fundamental analysis, I'll just go through the risk disclaimer as well. And that is, any information shared in this video is not intended to be a trade recommendation. It is solely the opinion and views of the speaker. So please remember to do your own analysis prior to entering any trades. We are here to help as well, whether it is asking a question in the chat for the LCMS Trading Club members, or for later on after the episode within the LCMS Trading Club forum as well. So we'll just get Gimme now to go through the Bank of England, and they did raise rates, but the pound did move lower as well. So I'll hand it over to you, Gimme, to explain the situation.
Yep, they did raise rates, but oh my goodness, they never fail to surprise me. Like for the past, I don't know, 2 or 3 meetings. Okay, bank rate increased to 0.75%. Okay, so the Bank of England did increase interest rate by 0.25% as expected. Okay, we didn't get the 0.5% that we all was hoping for. Okay, because of the war. It's obvious, right? More uncertainty. However, the immediate response, okay, the immediate price action for the British pound was a straightforward weakening. Okay, if you guys were to look at pound dollar, pound yen, pound whatever, okay, all the different cross pairs, okay, the 7 pairs that you can match pound with, all right, you will see that there's actually a super weakness in this whole pound across the board. All right, so why is that the case? Okay, let me show you guys. It's actually very simple. There's just 2 reasons. Okay, this time around, I don't know why it's kind of straightforward to decipher this whole Bank of England's monetary policy decision. Okay, so the statement was actually short and sweet. All right, it started off with Bank of England condemning the war and things like that. They are working with the UK government to support its response in coordination, blah blah blah, yada yada yada, and things like that. All right, and then these stuff, to be honest, doesn't really matter this time around. Okay, sets out monetary policy to meet 2% inflation target. That's basically the central bank's duty. Okay, the central bank's purpose, the purpose of having a central bank. And then central projection. It's probably better to wait for the quarterly economic projections, okay, before we focus on whether there's a revision and things like that. All right, and then moving forward, we see regarding inflation. Yes, we all know that Ukraine-Russian war has led to higher energy prices, hence pushing up inflation and things like that. Okay, GDP was stronger than in February. Okay, in January it was stronger than expected in the February's report. Okay, which is good. Okay, inflation, 12-month inflation rose from 5.4% in December to 5.5% in January, as expected. Okay, as well. What else? Okay, all this stuff just tells you that just basically telling us that goods prices have been increasing. What about this? As usual, the other explanation of why it's increasing and things like that. And this part over here, yes, we all know that Russia-Ukraine is a big shock to the economy and things like that. Okay, and we have pretty much come close to the end of the statement. All right, and of course, I don't know why they like to keep the whole conclusion, okay, to the end. I mean, not conclusion, but the most important point, okay? Given the current tightness of the labor market, continuing signs of robust domestic costs and price pressures, and the risk that those pressures will persist, the committee judges that an increase in bank rate of 0.25 percentage points is warranted at this meeting. Okay, so up to now, we haven't really feel the whole dovishness. Okay, now the dovishness comes in the minutes. Okay, so the first thing, I'm thinking which one should I go through first? Okay, as you guys know, the Bank of England, they announced the voting results, okay, of who voted for a rate hike, a rate cut, a rate hike by how much, a rate cut by how much, or to keep rates unchanged and things like that. Okay, they've always published the results openly. So without further ado, let's just look at the results. Okay, so the results are usually, well, when you go to the minutes section of the statement, okay, the results are usually towards the end of the minutes. Okay, so we can see over here at point 64, 8 members, okay, or these 8 voted in favor of the proposition. What proposition? Okay, point 63 states that the chair invited the committee to vote on the proposition that bank rate should be increased by 0.25% to to the level of 0.75%. Okay, so 8 out of 9 members voted in favor for this 0.25% hike. Okay, whereas one of them voted against. Okay, he prefers to maintain bank rate at 0.5%, meaning no hike. Okay, so this is the first point of dovishness. Why do I say that? Okay, if you guys remember from the February's meeting, out of 9 members, 5 of them voted for a 0.25% rate hike, and 4 members, okay, the other 4 members voted for a 0.5% rate hike. Okay, so previously 0.4 voted for 0.5, 5 voted for 0.25. Hence, the conclusion for the previous decision was a 0.25% rate hike. But this time around, we are getting 0 members voting for a 0.5% rate hike, and we get 8 voting for 0.25, and one of them, even voted for no change in rate hike, no change in interest rate. Okay, so all these, you can see that there's actually a downward, I would say, a improvement of the whole voting results. Okay, but of course, remember previously back in February, this whole Russia invasion of Ukraine hasn't begun, right? So everyone was actually quite hopeful that the Bank of England may actually carry out a 0.5% rate hike, which it actually was quite hopeful. I would say 4 against 5. It was a close shave. Okay, if there's one more member who actually voted for a 0.5% rate hike, okay, meaning there will only be 4 voting for 0.25, then we will be seeing, okay, a 0.5% rate hike last month. Okay, that will be very hawkish, but unfortunately it didn't. So we actually postponed our hope, okay, to the March meeting. But then comes the whole Russia-Ukraine war and things like that. Okay, and then of course we expect things to not turn out that well, okay, in terms of monetary policy decision. But then in the end, what we get is 8 members voted for 0.25%, and even one of them, okay, one of the 9 members actually preferred no change. Okay, so that is the first sign of a dovishness coming from the central bank. Okay, so whenever you guys analyze the monetary policy statement or monetary policy decision, okay, other than looking at the decision being made itself, okay, per se, always compare with the previous decision. Okay, if there's any changes, what kind of changes were there? Okay, is it like a less dovish or more hawkish, or less hawkish or more dovish kind of change? Okay, so in this case, I compared the March decision with the February's decision. Okay, and we all know that Bank of England's always released their voting results publicly. Okay, so a comparison of the voting results in terms of rate hike, okay, we can see that there's actually a worsening, okay, a deterioration of the optimism, okay, coming in from the Bank of England. Okay, hence the technical term to be used is dovish. Okay, more dovish tone can be sensed from, this time around as compared to the February's meeting. Okay, and the reason behind it, of course, is the war. All right, so this is the first point. Second point, again, a comparison is to be done. All right, now let's retract to point 62. Okay, now let me just read out this part for you guys. Based on its current assessment of the economic situation, the committee judged that some further modest tightening in monetary policy might be appropriate in the coming months. Okay, that's good. The Bank of England is, feels that with this whole assessment, maybe more rate hikes is appropriate. Okay, I would like to highlight these 2 or 3 words over here. Well, basically just 2. Might be appropriate. Okay, might be. Now, this is the March statement. Let's go back to the February statement and see what was the language being used. Okay, bank rate increased to 0.5%, February 2022. Same thing. Okay, we will scroll all the way down to the conclusion, to the last part of the minutes of just before the operational considerations. Okay, these operational considerations basically the how they're going to unload bonds back into the market, sell back the bonds and things like that. Never important about that right now. Okay, forget about it right now. So the conclusion for last month is this. The MPC judged that if the economy developed broadly in line with the February report central projections, some further modest tightening in monetary policy was likely to be appropriate in the coming months. Okay, so you guys probably guessed it already. The keywords here are was likely to be appropriate. Okay, was likely to be appropriate. Previous month was likely to be appropriate. This month might be appropriate. Do you guys, you see, it's a bit of a playing of the language over here. Okay, previously was likely. They are more. It sounds more certain. The Bank of England sounds more certain that it's probably likely more likely to for us to increase rate hikes more. Okay, carry out more rate hikes in the subsequent meetings. Okay, but right now it has been revised to might be. Okay, so it's this whole language thing. It really takes a bit of time to wrap around. Okay, for those of you who are like, I don't know, English literature major or something like that, you guys will probably be able to sense the less, okay, the more, how do I put it, the more reluctance, okay, to actually not carry out more rate hike, or less enthusiasm, okay, in wanting to carry out more interest rate hike in the coming months. Okay, so from was likely to might be. Okay, hopefully you guys can sense it, because I can't really, there's no fixed template to how this thing, this whole playing of language is, except having to read tons of monetary policy statements over and over again for months and months and see how price move. Then you will be able to, all these takes experience, takes time. Okay, and when you guys do this often enough, you guys will be able to feel that there's actually a change in the tone and things like that. So why do central banks do all these minor tweak in tones? Why don't they just tell us straight that because of the whole ongoing war, and we don't know how it's going to develop, we don't think we are less likely going to increase interest rates in the subsequent meetings. Why don't they just do a straightforward, just tell us straightforward? It's because of knee-jerk reaction. Okay, because as much as the central banks, the major central banks, duty is to achieve maximum employment, is to make sure that prices are not too hot. Okay, inflation is not too hot, inflation is not too low, and things like that. The decisions that they make are very very sensitive to prices. Okay, and there can be very strong knee-jerk reaction, which is why major central banks like Bank of England, Federal Reserve, European central banks, they always try to be as gray area. They use words that are in the gray region, be as, in a way, ambiguous. Okay, not non-constructive as possible. Okay, when it comes to delivering their forward guidance. Okay, so forward guidance in this case is, we can see that there's actually a a more dovish tone coming in. Okay, and look, just by these two words, change in 2 words, okay, has already led to a strong what do you call that? A strong depreciation in the British pound. Okay, can you imagine what if the Bank of England actually, were to go straight to the point and say that because of the war, and we don't know how it's going to develop, the committee members felt that it becomes more unsure, okay, that during the next few meetings, we will be increasing interest rate anymore. We are not sure if we are going to be increasing any more rates in the future, okay, and things like that. If they were going to be that straightforward, by how much can you imagine, by how much weakness, okay, pound can actually take up? You can imagine, from this whole straightforward point that the Bank of England is going to be giving up, okay, which is why for the past 1 year, okay, since the pandemic has 2 years, I would say, since the pandemic has started, we have been getting this very unsure, unclear sign from forward guidance, okay, from the Federal Reserve, okay, because they are probably the most important, the biggest central bank as compared to all the other central banks, okay, and the Federal Reserve's the decisions will have an impact on the other major central banks' decision as well, okay, if they start to tighten monetary policy, the other central banks may follow suit, okay, so everyone is actually eyeing on keeping an eye on what the Federal Reserve is doing, okay, which is why they have to try to play with words and make it as subtle as possible, so that when things happen, they can go back and say, oh, last year we actually delivered this statement saying that we are less reluctant to increase interest rates, okay, whether or not you guys get the clue is not to our best interest, okay, because if you guys get the clue, good for you, you guys traded, that's it. But of course, the monetary policy, the central banks are not acting in favor of the traders, right? They are actually acting in favor of the country, all right, of the country monetary policy. So whether or not we traders, we investors get these clues from the statement is really up to our own, capabilities and things like that. All right. So, and it's of course up to our own interpretation. Of course, there are too many experts out there in Wall Street, which is why you guys can see many of these strong impact moves coming in whenever these kind of subtle hints go about. Okay, if you guys were to look at some of the news articles on the Bank of England's meeting, okay, you guys would probably see that this might be thing and the was likely thing is actually a big deal in this time round's monetary policy decision, okay? But then, of course, some people will feel that because if you guys were to look at before the 1 hour, the 1 or 1.5 hours before the decision was being made, okay, from 1 hours before, you guys will see that pound was actually strengthening, okay, and some of the technical traders out there will actually be confident in saying that, oh, there may actually be a pricing in and things like that. In fact, when I was looking at a chart on and off yesterday, okay, I actually felt that pound was actually trading towards a key level. Okay, I think it was the 1.32 level, and then from there on they will move depending on how the Bank of England decides the decision to be. Okay, so there's a bit of a technicality there as well. Okay, but nonetheless, you see, no matter how there's no certainty to why things happen. Okay, but all these are the clues that we try to pick up from time to time to actually justify the actions, and of course, most importantly, give us the conviction to trade. Okay, so yep, this time around we get what we always call it a dovish hike from the Bank of England. Okay, dovish hike, I think it's not the first time that we are seeing it for the past 1 year or 6 months or so. I think the other central bank actually carried out something like that as well. Okay, I think it was the RBNZ or something. Okay, so yeah, 2 points over here. The voting got more dovish. Okay, the voting results got more dovish, and the forward guidance, okay, in this case, got more dovish as well. Okay, so this is actually, I would say, a good example of how we all should compare interest rate statements, interest rate decisions, or monetary policy decisions with the previous release. Okay, so because of all these comparisons, the British pound actually took a strong hit. All right, and let me see if there's okay. So the next meeting that the Bank of England will be up for is, I think, May 5th or 4th of May. Let me take a look. Okay, it's 5th of May. So that means they'll be taking a break in April, okay, which I think is a good thing, all right, because with the ongoing war, if they were to have a meeting in a meeting in April, then once again, they will give very unclear, what do you call that, forward guidances and things like that, okay, and it will be quite hard to actually project whether or not they will carry on a rate hike and things like that, okay. But as of now, the Bank of England's UK, okay, what do you call that, interest rate stays at 0.75%, okay, which is actually the pre-pandemic level. Also keep in mind that when the Bank of England has risen interest rates to 1.0, okay, that will pretty much be the time when the Bank of England will start to talk about, well, I wouldn't say talk about, but to start unloading its bonds soon, okay, because I think it was during the past, whether I think it was late last year, that the Bank of England actually mentioned that once interest rate hits 1.0, okay, they will start unloading bonds, okay. So right now, this month, they did not really talk much about it, and mainly because interest rate is still below 1.0, okay. So I believe once it hit 1.0, hopefully in May, okay, May's decision, they will actually have a plan of when they will start to unload the bonds and at what rate, okay. So the May's decision will also be important, okay, because personally, I feel that they will still be increasing interest rates, but by 0.25%, okay. At the moment, a 0.5% rate hike is pretty much off the table, or at least hanging off the cliff, okay. It's very unlikely right at the moment because of the whole ongoing war and things like that. Too much uncertainty already, okay. Even the Bank of England is is toning back down its forward guidance, okay. So any questions as of now? Why do I see buy as in what? Buy. Oh, okay.
No questions.
I thought there's some auditing of Bank of England
No,
statement and things like that.
It's a buy signal. Is it a buy signal?
No, it's not a buy signal, it's a sell signal. Okay, so if there's no questions, I will hand it over to Scott for his analysis on the DXY. Over to you, Scotty.
All right, thanks, Kimmy. And just now, so we did see a pullback on the US dollar. I've just got the 4-hour time frame up now, and we did get down to recent lows, 97.80. And I'll just zoom in and go to the 1-hour time frame so you can see what I'm talking about. So we did see this. This was back on the 10th of March as we went into the US session, and we did see it break down below 98.23. There wasn't a lot of a catalyst present as well to take along. So I just felt when I was seeing this happen, I just let it be and didn't have an order in just in case if we did see some further positive developments out of Ukraine. Things have just been a little bit dynamic. So I prefer to be around when I do take the trade on the US dollar. And we did see it rally a little bit, and we're approaching now that resistance level. So it's going to be interesting to see how this plays out from a news perspective as well. We did obviously have a lot of news out very early yesterday morning. But now if we just go to the news to see for today out of the US, it's not particularly high impact. We did have a little bit of news that came out last night, and unemployment claims was down a little bit, building permits, housing starts. They did actually beat expectations, but the market really was actually not too bad for stocks, and that seemed to be where people were still going into. So it's interesting. We've also had the tech sector bought up a little bit in the US and also in China. The Chinese tech stocks that have been bought up after some recent selling off, and then President Xi out of China did mention that they would be looking to cut regulations, but didn't give any specifics. But those markets have been really sold off so much that that's really where the action was. It wasn't so much really with the US dollar. It moved lower, but it wasn't a lot of downside, just given the fact that inflation's really hot still in the US, and we've got the the fact that there's still several more interest rate increases to come. So unsettled really to take a short. I'm more still long biased on the US dollar. And for later today, we do have for Friday night, this is 10 o'clock GMT +8, just existing home sales. We do have very early Saturday morning, FOMC member Bowman speaking, but it's not really super high impact. So really for the US dollar, it's just a matter now of how markets are going to absorb this. It was a little unexpected how it did sort of break down lower, and now it looks to be in a bit of a sideways range. So I'm still showing caution. And really, the catalyst is still Ukraine and Russia, because if things really develop in a positive sense, then that's going to be good for markets and more higher risk assets. So we well and truly could see the US dollar just come down a little bit, but then we've got the anticipation of the next interest rate rise. And if you add it up for where they see in the dot plot, there's going to have to be a 0.5% increase at one stage, is what I calculated it to be. If you added up all the, if it was all 0.25, it doesn't actually get to the total that they're seeing that they need to be at. So that is a point of interest as well. So when that could come sooner, it could come a little bit later. Our supply chains are still not really looking to recover anytime soon, unfortunately, with everything that is going on. So I'm just showing some caution here. And it doesn't really look like there's a lot of catalyst to put together a quality trade on the US dollar index. And I will go into detail as well, crypto, at the end of the episode. We do have Jin now with the CAD and oil as well. So I will hand it over to you now, Jin, to see how the CAD's looking for today.
Thanks for that, Scotty. I like how you say just extra caution at this point. I was just scanning through the charts as Kim Hong was explaining the Bank of England, and as you were going through the dollar index. What's actually been really interesting is that scanning through the charts, the Aussie, the Kiwi, the Euro, the pound, pretty much everything across the board is at a very high point. We've seen at a very high point because of the dollar, as you were just showing. I'll bring it up again. So the DXY, the dollar has been at that very low point, that 98 level, and it looks like it's bouncing back up. Same thing like what happened on the 10th of March. Looks like it might be doing that. So again, just be very careful for today, especially because it's towards the end of the week and possibly into next week as well. I think that we're likely to see, the buyers, Scottish buyers, come to fruition, where the dollar actually gains that strength from this 98 as a support, going up towards that 98.46, 98.50, and possibly even towards that 99.50 level. I think this might be a bit of a stretch, but if it comes towards 99, that's quite a good climb on the dollar from this point. So that would actually lead to a lot of retracements or corrections across the board for the Aussie, the Kiwi, the Euro, and especially the US CAD, right? US CAD right now sitting at the 1.2621 support level. The last time it was there, 3rd of March. So it kind of coincides slightly with the dollar strength that I was just sharing with you here, that happened on the 10th. You can see on the 3rd, we actually saw that dollar strength come back into play as well. So US CAD on the 3rd of March bounced back up. 18th of March now looks like we might see that bounce back up from this support level. We were just having a chat about this with one of the members in the Zoom chat, where, at this point, it does show a lot of opportunity either towards the downside or towards the upside. At this 1.25 level, if I went to the daily time frame, it's really that base there where we last visited in January this year. It bounced off from this point. If it does break below this level, hey, we might see 1.25 again. But at this reason why we also say that back to the H4 time frame, this support level is quite strong. Coming back to the WTI, we have seen the oil come back towards that 100 level. We were just talking about this last night with the members during the live session, that we were looking at it to hit towards that 105 to 110 level. It is at 103 now. Might not reach as high as 110, I think. We might sit there and possibly turn back down again, as we see the trend move and that retracement there. So with all that in place, I think that this is going to be quite an interesting point for the US CAD. So we looked at the dollar index, we looked at the oil prices. What else could happen is tonight, retail sales number for the CAD at previously minus 1.8%, expected at 2.4. Core retail sales minus 2.5, expected at 2.3. We're expecting to see a big jump in these numbers here. And if we do see that big jump in the retail sales number for the CAD, then we're going to see slight strengthening of the US CAD on the US CAD. Retail sales number is a good indicator of consumers spending, right? Which shows it could either show the confidence they have in the economy, or it actually shows the prices, the inflation coming into play, bringing up retail sales numbers. So what that all means is, at this point, two options. One is I'll zoom it in a little bit, right? One is to look for a buying opportunity. I would say you could be looking to buy above that 1.2645 level. Tight stop loss at about 30 pips. Take profit at about 60. You have a 1:2 risk-reward ratio towards the upside for the US CAD. And if we do see the dollar continue to weaken, not move as much, we see some strength in the CAD, we see oil price push higher, then you could be looking for that downside on the US CAD to sell down. I would be a lot more risk adverse on this. I would say below 125.94, right? Below 125.94, stop loss about 40 pips, take profit at about 80 pips. You still have that 1:2 risk-reward ratio towards the downside on the US CAD. So right now, sitting right at that level, you need the US CAD to move in either direction to give you that obvious trade, or the obvious trade opportunity. But this could either be towards the upside or the downside. This is a very strong support level. Stay out until you get a clear picture of what can happen there. So with that said, I'll pass it to you, Scotty, on the cryptos.
All right, thanks for that, Jin. And so with crypto, it's been somewhat interesting how it responded. And I'll bring up the chart now. So we'll do the Bitcoin chart against US dollar first of all. And this is the daily chart. So it's been pretty range bound. And for a trader, it's somewhat manageable to catch the low points here and then ride it up a little bit. We have seen it restrict a little bit. And it's going to be interesting to see how it does start playing out with the fact that the interest rate has increased and we're still seeing things, move okay. And over 40,000 is where we're at. We've recently seen lows of 33. 33 was back in January. And then we did see an attempt to break lower on the 24th. The wicks still, though, the dips are still being bought up. So we can see that with these attempts here. So what we might encounter is that we move to the upside a little bit more, and then that's where some selling takes place. So from a longer term situation, I would just say with Ukraine and Russia still quite unclear. Even though there's been chatter that the Russian population might be a little tempted to get into crypto more, simply because of the Russian ruble's devaluation, just because of really the inflation is going really high in Russia because of the sanctions and the fact that they can't really do anything because foreign currencies are unavailable to Russia as well. So what I'm seeing here is that there's a mixed situation of potentially people getting in still as a hedge for inflation, but the market is torn between, do we buy high risk stuff, and do we just leave more safe haven markets? And it's still a bit unclear. I mean, we've seen gold come off a little bit as well. So it is holding up okay, though. And we did do some analysis yesterday on that. So I'm still happy to say, more downside to Bitcoin as well, to around 33. I want to see it test 33 before I sort of think about even getting in at all. But I really prefer it to come down a little bit more. So if you just zoom out a little bit, you can see what I'm talking about. So that's really 29 or just below 29 would be a little bit better to see. I'm not particularly thrilled to see all this, and overall markets are starting to rotate down. Dips are being bought, but there's so much work to be done that the downtrend still exists, and I prefer to wait for the markets to move a little bit lower, just with all that uncertainty that's going on. And it's same for Ethereum as well. So as you can see, it's stuck in between this range of 2150 and 3200. So I just feel that it's best to leave that for now. And there's chatter about the Chinese stocks and especially the technology stocks with Alibaba, but it's still there's a lack of clarity on what is going to happen in China with these sanctions that have been threatened if China does help Russia as well. It's a tricky situation for China. So there's so much going on. I prefer to sit out and just leave it to play out. And then, we've got some currency movements that I'm, preferring to take quickly instead of the cryptocurrency stuff. Is you've just got a few more things to consider, and the volatility can get very unmanageable. If you've got a position you're not watching actively, and I find crypto moves better in the middle of the night in the US session. So that's why it just doesn't suit my time frames that I'm in this part of the world. But really for now, crypto, I just have to leave it. I did write an article for anyone that was a little more aggressively geared for the ranges and how to sort of play crypto in the medium term, if you're interested in checking that out for LCMS Trading Club members. But that's it for me for now, guys. Thank you so much for joining us this week as well. And I hope everyone has a great weekend. Don't forget to reach out if you have any questions in the LCMS Trading Club as well. But that's